Thank you for joining in. My name is Prashant. I head the Center for Business Innovation at Indian School of Business. Thank you for taking time out and tuning in on a Friday afternoon. I'll quickly introduce our esteemed speakers, Professor Rajendra Srivastava and Professor Ashish Sinha, and they will be taking it forward with regards to discussion. Professor Raj is a well-known academician and probably called as a pracademician in the entire business academic network. He comes with 4 decades of experience cut across different geographies, right from the United States of America, Singapore, and India. He has been he's been Dean for ISB from 2016 to 2021. Prior to that, he's been a provost and deputy president at Singapore Management University, and he's been a senior associate dean at McComb's Business School at University of Texas, Austin, and as well as Gazeta Business School at Emory University, where he established Emory Marketing Institute. His research is published in multiple journals, and as a global scholar, has produced great research published in multiple internationally renowned journals. He's championed interdisciplinary research and academic programs in the areas of excellence in financial markets, innovation, and business analysts. His current work on business model innovation in services, B2B technology, and emerging markets is of great value. And I welcome Professor Raj. Along with Professor Raj, we have Professor Ashish Sinha. He is a professor of marketing at UTS, University of Technology, Sydney Business School. He is a visiting professor at ISB and a senior research fellow at Center for Business Innovation. He has been academic dean for Center for Executive Education at ISB and is the acting head of economics at UTS Business School. He has launched and been running multiple academic programs such as Leadership in the Age of AI, Digital Transformation, Digital Marketing, Marketing Analytics, and FinTechs. He's considered as a pioneer in retail analytics in ANZ. He's assisted Aztec in setting up the analytics business in Australia between 2004 to 2010. With this note, I welcome both Professor Raj and Professor Ashish Sinha to the session. I request Professor Raj to take over the session.
Thank you, Prashant. I'm also going to take over the screen, and let's see if it is visible at your end. And so good evening. The focus of today's webinar is how do we accelerate emerging technology transformation for business innovation with a focus on growth, and I might add another word to it, resilience. So that's what Ashish and I are going to go through. But before I get into that, I thought I'd use this opportunity to talk just a little bit about the Center for Business Innovation. This is the first webinar that we're doing for CBI. And we are going to come online approximately once a month with a different topic. Another topic that will be coming up would be looking at how do we build e-marketing kind of capabilities. We're going to be looking at perhaps the leveraging of technologies in the fintech area, in medtech, and so on. So this is the first in the series. The vision for the center is to be recognized internationally. We are driven by research and insights. And what we want to do is we want to focus on how do we leverage emerging technologies to improve business performance, in particular, growth and resilience. This is the first such center, coming out of India. We are very focused on industry engagement and thought leadership, but I also wanted to emphasize that this is not just meant to be for India. We're looking at what is now popularly known as Asia Pacific, which includes Australia, where Ashish is from. But look at the Quad, if you will, Japan, Australia, US and India. And I believe UK has shown some interest in joining the group as well. We will be the platform and channel for innovations from India to the world, but we also want to facilitate the adoption of technology, from abroad and looking at the evolution of business models in India. With that, just want to give you a sense of what we mean by that. If we look at value added, a lot of value added is there because of design and R&D. Value is also added on the marketing side with customer solutions, with branding and marketing. But a lot of what we are doing sometimes in India is really assembling. So that's a pretty low value added. And what the center wants to do is to work with businesses to be able to go up the value ladder. So we're not competing on labor arbitrage, on cost arbitrage, but we are competing on the value that is being created in the marketplace. The second thing the center wants to do is to make sure that the companies we work with, the organizations that we work with, begin to understand what is driving market value, market capitalization in the marketplace. If you look at companies such as Microsoft, the price to book ratio, the market cap to book ratio is roughly about 14 or 15, which means about 6% of Microsoft is on the balance sheet. If you look at Google, it's a similar percentage that's on the balance sheet. I'm on the board of a small company called Happiest Minds, and their price to book ratio is 25-1, which means 4% of Happiest Minds is on the balance sheet. So we need to understand what are the assets that are really driving the value. The assets could be technology, IP. The assets could be human capital. The assets could be the network of distributors. The assets could be the brand. And the assets, could be the capability of the company to execute. So a lot of intangible assets there. And so want the center to lead the process by which we begin to understand the value of intangible assets and capabilities. All this is, of course, being enabled by technologies. And hence the focus of this seminar on looking at emerging technologies and how they can drive value in diverse areas, whether it is infotech, it is edutech, or it is medtech. And a lot of people talk about fintech. And I sometimes raise the question, is it fintech? Is it financial institutions adopting technology, or is it technological companies adopting finance? So a lot of change in the marketplace is being driven by technology. And certainly the focus of this center is looking at value migration and looking at how technology is going to enable that. A lot of work and talk has been gone on about platforms, platform thinking, looking at organizational transformation, digital transformation, and the importance of innovation policy. The government is often blamed for many things, how regulation may slow things down. But I feel pretty confident, and I'm sure Ashish will support me on this view, that when we look at Aadhaar, when we look at UPI, when we look at, for example, what is called the India Stack, it's the India Stack that has enabled us in India, mid-sized companies, to have a public platform. In the US, you've got Google as a platform, you've got Amazon as a platform. In China, you've got Alipay, we've got WeChat. But in India, it's a public platform which allows mid-sized companies and even smaller companies to get entree, into the dynamic, technologically driven world. The goal of the center is to understand all of this and use these insights to see how we manage things differently in healthcare, pharma, fintech or banking, financial services, and retail. A lot of work going on in omni-channel retailing. A lot of innovations coming actually from India in omni-channel retailing. And basically looking at how these insights can help us manage better. And I've shown many verticals out here. One is omni-channel innovations. It could be innovations in fintech, medtech, lot of very, very interesting work coming out of India in agri-tech. And when you combine the power of agri-tech with the power of fintech, that, for example, starts driving growth in the rural market. We're also looking at how boards need to think differently. There's things that we need to do for compliance, all the metrics that need to be reported and so on. But as we look to the future, CEOs and CFOs actually need to be strategists. Corporate boards need to be looking not just at compliance, but looking at what do companies need to do beyond the compliance requirements. We will, in the center, be integrating innovation thinking, but with the delivery mechanisms, whether it be related to the supply chain or it is the organizational transformation. And so we have some horizontals that cut through all the applications, but the notion really is, how do we improve the performance in the verticals? And that is basically what we are trying to do. It's going to be through research papers, it's going to be through webinars, it's going to be through advanced programs that are looking at business innovation. But our focus is going to be on what I would call evidence-based research that is supporting the growth of innovation and the growth of value creation. Now, for what I will be talking about is looking at business models, and then we will shift over to Ashish taking over and saying, well, how are emerging technologies accelerating the effective use of business models? So this really takes me back a couple of decades at least. And the framework that has evolved in terms of business models was actually, it actually came out of some work that I had done with a couple of companies like Advanced Micro Devices, with Texas Instruments and so on. And that led to the framework that is now closely linked to value creation and value appropriation. So to me, what is a business model? A business model is how do we create value for the customer, but also how do we appropriate value for the company that is serving the customer. So it's a two-way street. And in that context, what I want to do is give you some very, very simple frameworks. When we talk about shareholders, what are they interested in? Shareholders are interested in outcomes. What are the outcomes? If the company makes more money, that contributes to shareholder value. If the cash flow can be accelerated, that enhances shareholder value. Why? Because a bird in hand is worth two in the bush. Very simple. Investors don't want to see that value dissipate and disappear. So the sustainability is also an important component. Put very simply, you create shareholder value by making more money, making it faster, and making sure it does not go away. The investors need to understand what is it that you're doing that is so special that is going to deliver the top three outputs that we want: more money, faster, and resilience. So this is where investments come in. Are you going to invest in a brand? Are you going to invest in emerging technologies? Are we investing in AI, ML? Are we investing in sensors? So it's the whole evolution that is triggered by the appropriate investments. In the past, the investments used to be property, plant, and equipment, and today it is not, because as much as 90% of the value is not property, plant, and equipment. The second thing you need to really understand is value delivered to customers. Henry Ford said you can have any color car you want as long as it's black. The DNA of the Ford Motor Company and for Mr. Henry Ford at that time was that if I can improve the productivity of my factory, and his innovation was the assembly line. And Ford Motor Company, using the same type of factory, but with the assembly line process, was producing cars in 90 minutes when companies like Chevrolet were taking 1.5 days to do it. So much faster production. Therefore, the focus one was efficiency. The notion being that if I'm more efficient, I can bring the cost down, and therefore I can compete price on price and drive out the competition. Well, that is really not that different from what companies like Dell do or what Indigo does. Then there are companies that say, our corporate DNA is really on coming up with new ideas, new technology, new solutions, looking at differentiation as a way to create value in the marketplace. This is very typical. For example, if you're talking about Qualcomm, or we're talking about NVIDIA today, or we're talking about Pfizer, and so on. A third way to add value is, frankly, through customer centricity. And if you look at Apple and the price premium that Apple is commanding, it is, of course, through design, but it is also through the loyalty of the Apple customers who are willing to pay extremely high prices for products that have similar capabilities. Now, this is very simple. This was said by Michael Porter 40 years ago, that every company has to have customers. They need to understand who they are, what they want, and how we're going to deliver to them. So this is very simple. These are the value disciplines that we talk about. So essentially, the notion now is, what are the shareholders looking for? They want to make money. What do the customers want? They want value. In the old days, there was this notion of core competence, that you had to hang your hat on one of these things. Either be the low-cost leader or the technology leader in differentiation, or you've been focused on customer centricity and branding. What we find today is that the most successful organizations are ambidextrous. They're able to integrate these processes. And whether we're talking about Samsung or we're talking about Amazon or we're talking about Apple, none of these companies are third-rate players on any one of these three dimensions of product development, on customer centricity, and let's say the supply chain delivery. The picture that I'm going to talk about and how it evolved, and let me get rid of something here. So this work really started, for me, over 2 decades ago. I was looking at the tech sector at that point in time. And let's say if I looked at a company like Intel, what were they interested in? They were interested in investing in technology so they could keep ahead of the competition in terms of coming up with faster chips, coming up with higher performance chips. And it is that differentiation that gave them the margin. When the competition caught up with them, the margins dropped. So to them, differentiation was a key, much as a new drug is a key. The patent on a new drug is a key for a pharmaceutical company. When I talk to companies such as Advanced Micro Devices or Dell, they were interested in efficiency. And their focus was on trying to get to volume because the margins were small, but they could not rely on the kind of differentiation that Intel had because of the R&D. Talk to other companies, Pfizer, Samsung, companies like Gillette. Samsung was interested in business acceleration, and they always were looking at how to get to the market faster. A company like Gillette was interested in how can I improve product quality to the point that my high quality protects me from competition. So customer loyalty coming because of product quality. And if I was able to see a show of hands, I'm willing to bet in the audience that there would be at least a 70% market share for Gillette. Why? Because their products last and last and last. And you might see in the Gillette blades, they may put a strip like a blue strip or a green strip. And what they're trying to do is that when that blue strip goes from dark blue to light blue to white, that's supposed to convince you to buy a new blade. But the blades they have a very long-lasting capability. And that is what they've been focusing on in terms of customer retention. Intel and Apple, of course, have also invested in R&D. Switching over to the Procter & Gamble's and Unilevers of the world, they are focusing on creating brands that give them the margins. That thinking is not that different when you look at the Porsche. The average net margin on a Toyota might be $1,500. The average net margin on a Porsche is close to $40,000. So that profitability is being driven by the customer's willingness and to think of the brands as having pricing power. Then you got Charles Schwab, company that leveraged technology to accelerate the delivery of services in the financial sector. And you've got Zara, that is a fashion company, but is using basically flexible manufacturing, which they learned from Toyota to drive their business model. You then have companies like Singapore Airlines that focus on customer retention. And when you think of it, we people in marketing sometimes get blamed for some expenses, but nobody is blaming marketing for reducing the risk of a company. The biggest risk a company has is losing its customers. And customer retention is folks saving your company that. Now, Windows has been famously known, or Microsoft has been famously known for giving the product away with the idea that they're going to build in switching costs and they want you to try it for free, but you will be using them forever. So if I look at all these different strategies and I put them in the single framework, what is happening out here is that we have our original three market-facing processes. Customer management is referring to how do we, the customer centricity, supply chain management, and innovation management. And value appropriation is through enhancing cash flows, increasing resilience, accelerating growth. So this framework pretty much captures the notion of value creation for the customers versus value appropriation, for the business community. If I look at what's happening in the pharmaceutical sector, and I'm fast forwarding it so we have more time for discussion, what is happening in the pharmaceutical sector is that it is the R&D that delivers the molecule, that delivers the ability to deliver the margins. Then it is working with other pharmaceutical companies that gave companies like Pfizer the opportunity to use their strength in marketing and distribution to help facilitate the entry of other people's molecules into the market. And this is an example where Pfizer was the business partner to Warner Lambert for a molecule called Lipitor, which was used for controlling cholesterol levels. They followed branding as a way to accelerate the products into the marketplace, but also for customer retention when the patent expired. The detailing was used to get the product into the marketplace. And if you could accelerate the FDA approval process, it enabled them to capture financial performance over a longer period of time. The margins in this industry were so high, it was never a good idea to go out of stock. So you didn't want to focus so much on efficiency and inventory control that you went on stock. But you did want to make sure that you had delivery partners such as Federal Express that would ensure that the pharmacies did not go out of stock. More recently, what we see is the impact of brand and the impact of websites in managing these processes. There are tremendously high level of investments needed. But if I now put it within the same framework, what I was talking about at an aggregate level across multiple companies actually can be used as a way to analyze how is a company doing in the business operations that it's managing, whether it is related to product development, or it is related to customer management, or it is looking at demand or supply chain management. As we look at what is happening today, the world in the pharmaceutical sector has changed quite significantly. So you will see that we are beginning to talk about precision medicines. We are beginning to talk about medicines that are able to cure multiple diseases. So when you think of it, somebody who may have cardiovascular problems may possibly also have problems related to lung cancer. Why? Because there's a common factor called smoking that may have led to both the issues. It also happens that some people who may have cardiovascular issues will eventually develop diabetes, issues related to diabetes. So because many of the diseases are interrelated, this is where we begin to start using analytics to try to identify how a combination of medicines can be intermixed to create unique solutions at the patient level. So as we are looking at the pharmaceutical industry as it is emerging, it is beginning to use things like artificial intelligence, augmented intelligence, as Ashish will talk about. And it is now the use of technology that is beginning to shape or reshape the models that were being used. I'm going to accelerate. I'm going to actually skip one chart, and I want to hand over to Ashish, before too long. The chart that I just skipped was looking at performance metrics. But what I want to emphasize is this is our matrix that we were looking at. And as we look to the future, how do we enhance value? We enhance value through redefining the markets. You look at Amazon. Amazon, of course, started in retailing. Then they got into AWS, which is the cloud computing, because what they invested in the retailing business translated into a competitive advantage, that was in cloud computing. Then, with the advantage they developed in cloud computing, they were able to move, for example, into Amazon Prime in the entertainment industry. Now, some of those insights, some of that capabilities of understanding the market has allowed them to move into e-pharmacy. That's one of the latest businesses they've entered into in India. And I can guarantee you that within the next year or so, you will hear Dr. Alexa telling you what kind of medicines you need to solve your health issues. So Dr. Alexa is going to be online. Other ways to enhance performance is looking at platforms, looking at how do we integrate processes. Much of this can actually be driven through emerging technologies. How do we leverage emerging technologies to improve business performance? But along with emerging technologies, we also have to develop the capabilities of your organization to improve performance. So, long story short, we need to understand business models, which is how do we create value? How do we appropriate value? What are the processes for enhancing value to customers? What are the mechanisms for appropriating value for the company? And finally, as we look at process integration, how do we drive process integration and how do we accelerate growth? How do we accelerate the quality of decisions or quality of solutions available in the marketplace? And this is where platform thinking and so on is coming in. Over to you, Ashish.
Sure. Thanks a lot, Professor Srivastava. I'm going to just share my screen. Can you guys hear me? I just have to ask this question, it seems like. You can, right? All of you guys can hear me.
I can hear you, yes.
Yeah, sure. Yeah, that should be good. Okay, so I'm just going to pick up where Professor Srivastava has left off, in the sense that he's talked about a framework, and a framework that has been applied to numerous contexts, as he's shown. And then we'll come back and we'll talk a little bit about fintechs and pharma and so on and so forth. But as you can see, this is a corpus of work that I'm doing with exceptionally smart people, and some of them are here and in attendance as well. And the idea is that we are changing the narrative around digital transformation. And it's related to the work that Professor Srivastava has done. And it's about how do you use digital transformation, or that it's not only about technology, it's actually a disruptive strategy. And how do you use emerging tech and AI to unlock growth, build resilience, and also to create shareholder value. All right. So even though digital transformation is something that's been around, as many would say, forever. So what's new and different here? If you were to ask anyone, what is the definition of digital transformation? Apart from the fact that they'll say that it's about adoption of digital technology, they won't go any further. Because to be honest, you can check, there is no definition of digital transformation. So the three questions that I'm going to answer, respond to in the next 10 to 15 minutes is, what is digital transformation? Why should companies be interested in digital transformation? And whenever I say digital transformation, I mean emerging tech and artificial intelligence, but obviously, and how should companies embark upon the DT journey? And in that bit in the middle, why should companies be interested? Some of the things that Professor Srivastava just alluded to, about de-risking, about growth, all those things I'll be covering. I'll show how our kind of framework, the DT framework, links to that. Okay. So where I'm going to start is that there's a lot of hype around artificial intelligence, and whether it is AI or whether it is emerging tech, it's one and the same thing. Here's an example of, in 2019, Roger Federer ended up losing Wimbledon. He would have been the oldest player ever to win Wimbledon, but he lost it to Djokovic because he committed an unforced, uncharacteristic forehand error, which he normally never does. And there were a lot of people, some of the AI researchers, who kind of thought that this will come back to haunt him. So they recreated this whole, so to say, game or a match. And lo and behold, the predictive analytics would show that Federer wouldn't commit that mistake, and therefore he won the game. And so to say, the normalcy was restored, right? And so real this experience was that even someone like Federer said that, gosh, he couldn't believe it. It seemed so real. So this one, probably many of you have already heard of. It's AlphaGo, which is, it's often termed as the Sputnik moment for China, because it was, I hope I resume share. Yeah, 1.3 billion people watched a machine beat a human being, right? And Lee Sedol is the champion of Go. But DeepMind, who came up part of Google, didn't stop there. They came up with AlphaFold 2, which was one of the grand challenges of the last 50 years or so. And that was to do with how amino acids kind of interact with each other to form proteins, right? And that was considered to be a major breakthrough, hadn't happened in the last 50 years. And DeepMind came up with a solution. And boy, everyone said that, all the computational biologists now, or the biologists, they don't have to do much because everything's pretty much done. So if you were to believe popular media, essentially, it would be as if everything has been achieved. But the reality actually is very different. Because if you look at the dissatisfaction with data and AI technologies, believe it or not, it's at an all-time high, right? So you can look at this, and we've done a lot of work, and the responses that we get is identical, that people are dissatisfied with artificial intelligence, with emerging tech, to the point, like some of these things like emerging, the virtual assistant or chatbots is as high as 73%, right? So, but also what you see is that there are two sort of companies that use emerging tech and AI and data related assets really well. They're either, the very large companies like the FANGs, or they're startups. I mean, I know, there's this whole thing about how technology firms are bleeding, but regardless, I mean, yeah, they've gone down by $1.3 trillion. So they were worth 9 trillion, and now they're worth $7.7 trillion. Well, that's a lot. And if you add, Alibaba's and PDDs of the world, they would be the third largest economy on the planet, right? So they are doing something right. And so are the startups, because they essentially are risking everything on this new technology, right? So essentially these, if you combine them, more or less 80% of the companies that are successful are these, or more than 80%, 90% of the firms. So rather than talk about, or rather than think about, focus on the hype, why not, how do we harness emerging tech and AI? I'm also going to minimize my windows, and AI to build competitive advantage and enable disruption. That's what I'm looking at this point, right? So, and one of the things that you have to do, and which kind of relates back to this whole notion of business models, is that you've got to think of how do you monetize data, or how do you monetize emerging tech? And as this article says, well, digital is great. There's a lot of emerging tech, and there's a lot of, talk about AI and data and how it can be used. But where are the new business models? At the end of the day, we can't just keep using the same business models as what we've done, and was what Prof. Srivastava was saying. It's about how do you create value with these new emerging tech, AI and data, and then how do you appropriate value differently? But if you're using the same things, well, as this says, well, the enterprise is going to fail. So it's a very simple equation in some ways. It's like you use data, emerging tech and artificial intelligence, and then you have to come up with new business models. And what I've got at the bottom is, data and emerging technologies are cheap as salt at this point, right? It's not that expensive anymore. It's the business models that count. And unless you have good business models of creating value and appropriating value, regardless of what kind of technologies you might have, you will fail as a firm. So, I'm an academic, and I kind of want to look at things, simplify things in a simple way. And what I've got here is, like, you've got the old technology, or the non-AI and emerging tech sort of technology. And then you've got the data and new technology, while old business models and the new business models. A lot of the firms are here, right? And so if you move over here, that's where you are adopting AI and or emerging tech. Now, if the business model stays the same, and what you're just doing is adopting emerging tech, then essentially it's about pushing out the efficiency frontier, reducing costs, and or maybe trying to understand the existing customers a little bit better. I mean, that's pretty much it. Where explosive growth happens is here, where you come up with a new business models using data, AI, and emerging tech, and that allows you to target a new segment, a new set of customers that you were not able to target before, right? So unless you are in this space, even if you are on this space, on this side of the continuum, unless you are here, you will not experience explosive growth, like some of the examples of the big tech that I have provided you previously. So, some of the native digital, everyone kind of knows, they are in the so-called, I call it the fourth quadrant, Uber's, Airbnb, Facebook, Flipkart's, Alibaba, and so on and so forth. I mean, all of them are pretty much in the fourth quadrant. But what is much more interesting are those that have been successful in going from the first quadrant, the incumbent quadrant, to the transformation quadrant. And it's companies like Microsoft, which kind of everyone knows that before Satya Nadella, it was not a small firm. It's like a $280 billion firm. But then Satya Nadella came in and he changed the whole firm. And it was cloud-based, it's got emerging tech, it's got new Azure, all those things. And today it's worth $2.2 trillion, right? The second coming of Steve Jobs was the same, that they went from that Apple, being about hardware and software, became a digital firm. And with the release of each and every product, like whether it's an iPod or an iPhone, they had a totally different business model. And today, Reliance, they're trying to do exactly the same thing as what Shopify is trying to do, right? With signing up with Google and Facebook and all those. So all these companies are some of the examples, or very successful examples, of this whole transformation of how they moved from the incumbent quadrant to what we call as the digital transformation quadrant. So this is the technology and business model. I've kind of shown you before. A lot of firms are here, like originally, and then they kind of move here, right? And Netflix and all of them also went along this whole journey. But the problem is, if we know what needs to be done, the problem it's not that easy to move from the other quadrants to this one, right? To the growth and the digital transformation quadrant. So what we've done, we've come up with a framework, but obviously, it's borrowing some of the thinking that Prof. Srivastava just shared. And that to think about organizations as nothing more than assets and capabilities. So you've got organizational assets, and if you're talking about digital transformation, but obviously there's going to be data-related capabilities and data-related assets. And when I say data, I mean emerging tech as well. The convergence happens. So, regardless of what emerging tech you're looking at, whether it's an IoT, whether it's blockchain, whether it's 3D printing, at the end of the day, the convergence comes through artificial intelligence and data. That's what they're generating. They're generating loads and loads of data, and that needs to be mined in some ways. And so, that's why data-related capabilities are very important. So, so the organizational assets, some of them are data-related assets, some of them are emerging tech. But the big difference here is that unless that is used to understand the needs of existing customers, so customer centricity, the whole notion of emerging customers, well, it does not turn into a competitive advantage. The notion of competitive advantage is that you have come up with a new business model that allows you to target new markets, because now your customers a lot better, but not only your existing customers, also the emerging customers. But the important part is this is a transient competitive. If all that you can do is this, is a transient competitive advantage. It's only if you are able to target certain segments that the current competitors are not able to target for whatever reason, right? That's when it becomes a disruptive innovation. That's when it becomes a sustained competitive advantage. And then, as what Prof. Srivastava just mentioned, what it does is that it increases the cash flows. All these things, if you were to able to do this, then it increases the cash flows, it accelerates it. And not only that, it reduces the volatility, and that increases the shareholder value. And this is a virtuous cycle. So, you go back and you sort of invest in all these things, and you have more money, which is what is happening to big tech. I mean, they keep growing because of the virtuous cycle, that they keep, becoming bigger and bigger and bigger, right? So this is the framework, which, I don't have time to sort of unpack each and every part of it. But if you were to take a course from us, and we've taught a number of exec ed courses, that's around this, how do we sort of unpack it? So sort of I've answered two questions, hopefully by now. What is digital transformation? It's not only about emerging tech, it's actually about coming up with a new business model, which is about value creation and value appropriation that allows you to target new segments that you couldn't target before. And if it also allows you that your competitors can't, that's when it becomes a disruptive innovation or a sustained competitive advantage. But the bit, and so why should companies be interested? Again, the shareholder value, increases the value, and I've shown you some examples of that. The third part is, how should companies embark upon digital transformation? At the end of the day, it is a transformation. So again, going back to this whole notion of capabilities and assets, there are some data-related capabilities and assets. So in case of data capabilities, these are some of them, right? Data curation capability, data governance capability, data factory platform capability. In a minute, I'll define it, but we'll go through it very quickly. Don't have the time to do it. Otherwise, we won't be able to have a proper discussion. Then it's the modeling, building capabilities of technology, and as well as the managerial. And then is the market-based assets capabilities. Either you build or you leverage market-based assets. So these are some definitions, like data curation. So there's some data-related capabilities that organizations should have if you're interested in that transformation. And then, there's a modeling capability that you should have. Managerial capability, important part there is that the leader should have data-led growth mindset. And finally, unless you have this, this to us, we've seen in a number of analysis that we've done from data that we have collected, that this is by far the most important. Like, unless you have these market-based capabilities, you will not be able to convert that into a competitive advantage. So, as I've mentioned that over the last 24 months, we've taught a number of, and when I say we, sometimes with Professor Srivastava, sometimes not, taught a number of exec head courses and also otherwise. And we've collected data from them where we've asked these executives, and many of them are, from the C-suite, so they're CEOs and CMOs, and we've asked them, how do they rate their own organization on these capabilities, right? So whether it's a data or it's modeling or a managerial or the market-based capability, ask them how prepared or unprepared do they think their organization is for the adoption and deployment. And then the last one is, what quadrant are they in? Are they in this one, this one, this one, or this one, right? So this is where it's the business model is new, as well as they are adopting the technology. So it's technology is new and the business model both are new, right? And here are some results. I mean, there's just a snapshot. So you could see in each and every, whether it is to do with preparedness, whether it's to do with managerial capability, whether it's to do with market-based assets or competitive advantage, the transformation quadrant, like companies, executives who believed that their company was in that transformation has a higher score, right? Even for competitive advantage. So that means, unless you are in the fourth quadrant, so the efficiency quadrant, which is this one, so you still have new technology, but an old business model, that will not allow you, or that's the perception of the executive, that it doesn't provide enough competitive, there's not enough to create competitive advantage. So yeah, so pretty much that's it. So, trying to answer these three questions, but also showing how the framework that Professor Srivastava came up with, or was describing, how it applies to this as well. Okay, and that's pretty much it from me. And I need to stop sharing screen. Thank you. And I'm back to Professor Srivastava. Professor Srivastava, I actually do have a question for you, which is to do with, what do you think of the framework that we've come up with? And how does that apply to fintech, given that you mentioned previously about rural India and how fintechs now can target a segment of the population which didn't have access to financial products before? And I know that you have done some work in that area.
Thanks, Ashish. The question that you're bringing up related to rural India, a broader question would be, the financial services sector overall.
Sure.
So, the issue is, what's the value of information? Number one, data and information provides insights. And the question is, how can one leverage those insights in order to develop maybe new products, new ideas, but also how you can accelerate. So I'm going to give you one answer which is related to rural India, and I'll give you another example. You've talked about Google and so on and so forth. I'd like to talk a little bit about what's going on in India as well. And so when you look at rural India, when is it that they need money? One is, of course, related to the family, that children, education, and things along those lines. But importantly, if you look at agri-tech, if you look at the agricultural business, they need money when the planting is going to take place. They have to pay for seeds and fertilizer, for tilling the land, or they need money when it comes to harvesting. So those are two time periods when you need money. And that is the time period where farmers used to have to go to the local moneylender, and the moneylender extracted a lot of value. Furthermore, they had to sell the produce that they had at the mandi. And the mandi, as you know, is an auction. And there, people who had asymmetric resources and asymmetric information took huge advantage of the farming community. Now what is happening is that some of the banks are using information of the previous planting and previous fossils and so on, and harvesting. And by using blockchain, they're able to establish the credibility. So rather than having a credit bureau, you're using blockchain to establish the credibility of the farmers. And farmers are being offered loans, without they're being pre-qualified for loans, based on the data. That makes more money available to them at the right time, but it also ensures the financial services community comfort that they're going to, based on the past information related to blockchain, it gives them some comfort that this is a fairly safe investment to give. So it helps. So what is now happening is that people are beginning to combine agri-tech, which is seed, fertilizers, etc., and they're combining them with fintech. And very, very interesting, companies coming in. Now they're also beginning to combine agri-tech, fintech with martech, meaning marketing technology, to begin to take the product to market. So this is an example of the use of data in improving the productivity in the rural areas. Now, Ashish, you talked about Google, you talked about Amazon. I myself mentioned Amazon. But I did mention that India has the India Stack. So one of the companies that we could look at is, let's say, State Bank of India. State Bank of India has a product called YONO. YONO stands for You Need Only One. So your mortgage account, your checking account, your credit card account, your car loan, your automotive insurance, your life insurance, all of it is coming under a single umbrella. What this does is a fair amount of cross-selling. The marketing is more effective. And you may have heard of the term, the strength of weak ties, or you may understand the concept of a rope. A single strand of a rope is pretty weak, but when you combine multiple strands, it becomes strong. And that is exactly what happens in the financial services sector. If you have a customer that is a customer across multiple products and services, that customer retention rate goes through the roof, and that increases the value of the customers. And Ashish, you mentioned that it takes the uncertainty out of the market. It increases the resilience, and the cash flow is more stable. And so technology is also enabling through eKYC. People talk about fintech. Fintech is not so much innovation in the financial product. It is the innovation in how to manage customer relationships. And what is happening out there when State Bank came in with YONO, they were onboarding 30 to 40,000 customers a day. And about 1,000 people, less than 1,000 people employed in the YONO part of a State Bank could be providing as much as 15% of the output. Now, State Bank of India has over 200,000 employees, and 1,000 employees could be providing as much as one-fifth of the business. So if you look at the productivity that comes along with the analytics, but you have to combine the processes. And a statement has been made, by the former chairman of the State Bank of India that could possibly be worth more than the State Bank of India itself. Again, I want to kind of stop at this end because information is very valuable. When you combine information with changes in processes, what used to take 30 to 40 minutes to onboard a single banking customer takes 2 minutes today. And so the productivity is all along the value chain. One other thing to mention, I made the comment in agri-tech, combining it with fintech, combining it with martech. Previously, we used to think of linear supply chains. It is information and the platforms that are enabling what I would call management of the ecosystem, managing of the platform. And Ashish, this is an area that you specialize in. So if you ask me a question, I'm going to throw the question back at you. Okay? Which is, how can platform thinking help Indian companies?
Sure. So I think, there were a lot of really great points you raised that I just wanted to sort of touch base on very quickly. And one of them was the power of having information and data, which, you sort of, in your explanation of fintechs and ag fintech, because a lot of these farmers, as what you're mentioning, don't have collateral. They don't have a house. They don't have, wealth. And so a normal bank will look at them and will not disperse a loan to them, because they don't meet the criteria. But now when we use collateral as our data as collateral, and not only that, we can process that using, I'm just going to call it analytics rather than always calling it artificial intelligence. It is basically analytics, and artificial intelligence is a part of that. So we can do it now in maybe 2 minutes or a minute. It suddenly changes the ability to make millions of decisions in a day or so, which would take us a year or a couple of years to make. So I think that is one part which is very critical. The other thing that you talk about is platform. Even with ag fintechs, one of the biggest problem is trying to link the first mile with the last mile. So in the sense that insurance companies and financial products have existed, and then you have farmers who have needs. But the problem is we don't have a platform, or we don't have a place where you can bring these two together. So to your point, while SBI has done a really great job at doing all this great stuff that they're doing, but unfortunately what they haven't looked at is how could they leverage the power of this platform to create a marketplace where you could bring this first mile and last mile together, and not only that, that information could be of use to other companies like fertilizer manufacturers, or it could be for, land registries, but background. So that information is not only restricted to the banks, but it could be off now. So once we start, so this whole notion of managing the ecosystem that you just mentioned, even in a simple example like an ag fintech, you can see how we can have multi-stakeholders and how they could create value from, or they could extract value from the data that is generated from farmers who at one point, nobody wanted to touch them with a barge pole because, they didn't have any form of collateral, right? So just that information that they're providing, and if you've got a marketplace, and then you can bring in, different actors and players, changes the whole landscape And I think that's what the Indian companies perhaps haven't done as much as what they potentially could, and particularly, in the rural areas and some of the issues that we are facing in the rural areas.
So, Ashish, great point, but some of the things that you mentioned are actually already happening.
Okay.
If I look at Yono, the description I gave initially sounds like a B2C move, right? The bank to consumer, that kind of aggregation. So that's the B2C side. Now the question is, who else wants that information? Who else wants the access to those customers? What is already happening is that development of that B2C access is creating a B2B opportunity. So
Yes.
Let's say you look at a company, whether it is BMW or Maruti, all right? Would BMW or Maruti be interested in knowing who are the creditworthy, customers at the State Bank? Who are the people who've got great purchasing power left, etc.? And yes, they would like to have access to that. And State Bank of India can tell BMW or Maruti, for that matter, that, hey, if you want access to my customers, you're going to have to give them 5% off. And if you're willing to give 5% off, I will be willing to let them know. I'm not going to tell you who they are, but I will let them know that you're in the market to give them a discount. And in effect, what they can do is appropriate value from the B2B clients based on the value they have created on the B2C side. So this kind of activity has already started. And so lots of interesting stuff going on. I had another question for you. And actually, we should pretty soon start asking the questions that may be coming up in the chat box. And maybe Prashant, you could bring up those questions that Ashish and I may not be seeing. And the question, Ashish, I'm bringing to you is, you're sitting out of Sydney. You're looking at India from sitting in Sydney. What do you think is the likelihood that, let's say, Indian fintech innovations will be able to contribute to the West? What I'm referring to, what's the potential for reverse innovation? Or if I make it an example, can the State Bank of India help the Citigroup?
I have absolutely no doubt in my mind that the next 20 years, you will see a lot of reverse innovation, primarily for the reason that with the scale that India has, there'll be problems that the companies will face, and whether it is to do with the access of data, the quality of data, the data mining, all these sort of things, and many of the other things that are related to problems that I think will provide them to innovate, to come up with new ways of doing things, which could be in the form of new business models, or business processes, or ways to target, customers that no one's ever at this point ever even dreamt of. So I would say that there's a lot of potential of that happening. So the reverse innovation, whether Indian companies, because the market in India is so huge, whether they're really interested in moving out of the market is something that I'm not certain. But I think that's the problem that a lot of the Chinese firms face today. That because they had a large market, but then, as you know, the economy goes up in cycles. So while the going is good, there's nothing like being in your backyard. But when things start tanking up, it's time for you to diversify. So diversification is equally important. And again, that is something, and maybe I don't know enough. Professor Srivastava, you know a lot more than I do. I don't see enough of that happening in India currently, the diversification.
Okay, so I'll give you one data point, and then I'll let Prashant pose some questions from Q&A. And during the last 15 months, January 2021 to March of 2022, there have been 50 unicorns that have come up in India. About 40% of those unicorns are in the fintech space. Another 30 to 40% are basically in e-commerce, in the e-commerce space. And we are beginning to see a lot of ideas that have emerged. For example, in the business models in the e-commerce space have incorporated the Kirana stores and into the ecosystem. And that model has been exported to Mexico, to Brazil, to Indonesia. So that is happening there. And in the fintech space, we're also beginning to see that happen. So, many of the ideas are being developed and implemented, not only by large companies like State Bank of India, but we're looking at young Indians who are very, very optimistic and aggressive in their desire to expand globally.
Sure.
So I am a little bit more optimistic, Ashish, than you are. But
I hope you're right.
But let's. So Prashant, are you going to moderate or ask questions, or we could also just go to the Q&A.
Yes, Prof. I'll probably just pick up some questions that have come in.
Okay.
So one of the questions is, with the rising popularity of platforms and ecosystems, do you think ecosystem orchestration might replace supply chain management as a market-based capability, or do you see it as a separate capability altogether?
I think the answer to this one is the Pope Catholic.
Yes.
The answer is yes.
Yes. Yes. I mean, the ecosystem orchestration is going to be by far one of the most important capabilities. It's sort of, our conversation around that fintech example clearly provides that, evidence as to why we believe that way, right? So I think absolutely. So the ecosystem orchestration is going to be.
Well, let me kind of chip in a little bit. When we think of technology, immediately we're jumping to e-commerce. We're talking about, fintech. It's going to really change other businesses as well. Look at the automotive business, parts supply, repairs, and so on and so forth. Already, information systems are linking the suppliers, for parts and components to the repair shops. And it is making that system much more efficient. So let's say if I was managing a repair garage, I have enough space to have 3 cars that my small little company can work on. If I'm waiting for parts and components, it's eating up space. In effect, it is reducing the turnover for my little garage. And if you can speed up the delivery of parts and components, what that is doing is it's increasing the productivity of that small garage. It is also increasing the productivity of the company that is providing, the components. And it is, so these kinds of changes we are beginning to see. It's not just fintech, it is all kinds of businesses are beginning to benefit with the integration. So it's no longer a linear supply chain. Insurance companies, parts providers, repair shops, all of these guys are getting integrated. So the ecosystem integration and ecosystem management is the next best thing. And we have all heard about things like a decentralization yes. So, for example, if you think of banks, what do banks do? They're the financial intermediaries. If you look at retail stores, what do? They are product intermediaries. And when we in finance, we're talking about DeFi, decentralized finance, DEFI, decentralized finance. We're also seeing decentralized, retail. So direct to customer is decentralized retail, right? So a lot of changes are taking place in the marketplace because now we're beginning to see the number of layers that were in the intermediary, those layers are being compressed, and we're seeing a lot more efficiency and therefore a lot more productivity in the management of ecosystems.
So essentially what I think, on my bit that I would like to add is that the platform thinking can be applied to traditional firms as well. Just to think of the application of only to e-commerce or fintechs, it can be applied to. So it's much more about the mindset and how we approach it, rather than just looking at ecosystems or e-commerce and saying, well, that's where it applies.
Ecosystems are everywhere.
Everywhere.
In food, in car repair, all over the places. Linear supply chain is, I think, going to be under a lot of stress.
Yeah.
Thank you, Professor. There's an interesting question, and here it is. There is a recent trend to focus on profitability and sustainability of these new age startups by investors and demanding more seriousness. How do you gauge this shift evolving?
So is the question that the focus is now on both profitability and sustainability? And how do you balance these two? Or is that the question? Because I was not certain of that, Prashant.
Yeah, I think the shift of the importance of sustainability coming in is where the focus is of the question.
Yeah. Okay. Prof. Srivastava, you want to, or I can?
Why don't you take a shot and I will come in after you.
Sure. So to me, it's not about purpose and it's not about profit. It's trying to combine those two. So purpose meaning, sustainability and whatnot. Because at the end of the day, if you don't have profits, like, I've seen this at multiple places where it says profit to purpose. But if you do not make a profit, then essentially you go bust. And then that has a huge impact on a lot of people who are dependent on this company surviving, its livelihoods and things like that. And I take an example of Sri Lanka, where they went organic 3 years back. And today the food prices have skyrocketed, the starvation and hunger and all those things, because the focus was so much on organic farming and sustainability, but no focus on, the other bits which were equally important. It was applauded by everyone, by the way, including UN, and, they were going to become the role model. But today the situation is very different, right? So I think it's important to combine both, right? So, and the example that I give, if She Rose, you know about that She Heroes, that particular, social enterprise, where they, if you look at that, it's bringing in purpose, it's bringing in profit, so it's giving employment to women who are acid attack, right? So those women, but so they're giving them employment to them, confidence that they had lost, but at the same time they have, pay what you can for the customers. So, any and everyone can eat there and they don't have to pay anything on, if you can afford, you can pay 10,000 rupees for a meal, right? So it's dependent on you. And there are a lot of people who do both, right? So you are bringing the whole community, again, going back to this whole notion of ecosystem being applied to a social enterprise where there's profit, there's purpose, and you bring everyone together rather than just looking at, to the example that I provided you. It's a very dreadful example of how many people today are dying, and all the countries that was once supporting them have pretty much washed their hands off and walked away, right? And it's Sri Lanka that is stuck in this horrible situation. So to me, it's not so much as a balance. It's again going back to what Professor Srivastava said. It's an ecosystem thinking that has to be applied to firms in which you have multi-stakeholders, and one of them is society. And how do you bring them in rather than saying just focus on society, don't worry about profits, because then you go bust, and the adverse impact, as what you've seen in Sri Lanka, will happen, to firms as well. So that's my 2 cents.
So I have an additional perspective to the same question. If you look at profitability and sustainability, they need not be orthogonal. I think Ashish was saying that as well, that you could do both, things that are profitable and sustainable. So think of, when we think of products, we typically think of designing them and selling them, and then we're done. But some of the new circular designs that are coming up, you design the products in such a way that instead of looking at the cost of buying and selling, you look at the total cost of ownership. What is going to be the cost over the life cycle of the product? And in that case, what you're doing is you're designing products to last longer. Now, the problem is the following. If I was selling you a car for 20 lakhs, and then if the car was going to last 10 years rather than 5, you're not going to be making that much money as an automobile manufacturer or a dealer or something like that. But when we start looking at products as a service, we keep talking about software as a service. There's nothing that prevents products being a service also. That if you are saying, okay, if you can rent a car, you can also lease a car, but it could also be a contract where a manufacturer can go to the customer and say, we're looking at it over a 10-year cycle, and if the product can last longer, then the degree of waste is reduced. If the degree of waste is reduced, that is going to be a more sustainable solution to the planet. The amount of waste that we have, whether we're talking about plastics or we're talking about lithium-ion batteries or we're talking about computer screens, the amount of waste that we have is phenomenal. So if we can increase the duration over which the product is used, and that increase could be because of the increase in quality, or it could be because of the continuous improvement. So instead of throwing the computer away, computers are being updated, online. And these kinds of improvements are going to increase the sustainability while increasing the profitability. So think of a longer-term solution as opposed to selling a product here and now.
Thank you, Prof. I think that was very insightful. Another question that we have is very similar in continuation to the sustainability. Is carbon neutral initiative for India is planned by 2070. Would like to know CBI role in this initiative. Globally, everyone is struggling to develop sustainable alternatives and direction government businesses to achieve or align with this carbon neutral drive. So I think essentially it is what sustainable alternative.
Ashish, I'll let you handle this one.
Sure. It goes back to some of the points that you have raised a couple of minutes back and what I've mentioned, that it doesn't have to be orthogonal. And when it comes to carbon neutrality, one of the things that is going to be, when we say about sustainable solutions, the sustainable solutions have to be both from a profit and revenue perspective, but also that it's good for the stakeholders in society, right? And so if the sustainability comes at the cost of profitability, then that is not good, because in the long term, all these firms are going to fail, because it's essentially, we are providing subsidy. Someone is paying for it, whether it's a government or what. So I think everything that the center does, even the presentations that we had, the 2 presentations today, was exactly about that. How do you balance? How do you bring these 2 together, right? We just can't focus only on purpose. We can't focus on profit. We're well aware of that and what we have to do. And so the ecosystem thinking, the platform thinking, the fact that we have multi-stakeholders, how do we bring them in, right? It's nonlinear supply chains. That all of that is going to play a critical role in us being able to achieve carbon neutrality as a country or as a planet. And unfortunately, no one's having that conversation, by the way. So I think, we are thought leaders. The center is a thought leader in this space already without doing anything, right? We're already like way ahead of anyone else, I think. So yeah, sorry, Professor Srivastava, over to you.
No, so to me, the carbon neutrality could be across multiple products. And so maybe I'm creating some carbon emissions here. What can I do somewhere else that will absorb the carbon? And you look at India, we've got a huge, we've got a large population. We're one of the most densely populated, countries in the world, and a lot of the forest land, etc., has been eroded. And we need to begin to look at what is the impact of one policy on something else. So when we're looking, if we want to, improve the environment, one could be reducing carbon emission, but at the same time, what could also be planting trees that absorb carbon. So we need to start thinking of the larger ecosystem. India this year has exported $50 billion of agricultural produce. A lot of it is, frankly, things like rice. Where rice used to be coming from Orissa and Bengal, rice is now being produced in Punjab. How are we producing rice in Punjab? We're taking water out of the land and we're using that for immigration. India is one of the major producers of rice, second only after Thailand. So when you're exporting rice, what are you exporting? You're exporting water.
No.
Okay. So we have to think of the whole ecosystem. We can't look at one product at a time. And that's partly what I'm also trying to say, that when we look at carbon neutrality, there may be some things that are essential. So maybe we do need transportation, and yes, we can improve by going to buses based on compressed natural gas. That would be an improvement, but we could look at other ways in which to reduce the carbon emissions or to absorb the carbon. So let me just stop at that.
Thank you, Prof. Just a couple of more questions in the interest of time. As you mentioned, most of the unicorns from India were from fintech. What do you think the reason could be behind this? Why not from the other sectors? Are the startups not becoming unicorns?
Well, since I made that conjecture, let me give you my 2 cents worth. One is think of the India stack, Aadhaar, UPI, etc., etc. Think of it as a digital highway. Just as you have a physical highway, think of it as a digital highway. And the digital highway has enabled this to happen in part. Okay. And the second thing that is enabling all of this is that India has now become one of the few countries where we have pretty visible growth. And so 7-8 years ago, when I was in Singapore, and I would talk to mid-sized companies would be $50 million at that point in time, 200 crores, something in that range, annual turnover. They had a good business model, good ideas, but they were growing only at 5 or 6 or 7%. And if I asked the chief executives, this is a great idea, why don't you scale up? The response used to be working capital, access to money. That is what was holding them back. Maybe Indians at that point in time were storing money in the mattresses. They were storing money in gold. They still are storing money in gold. And working capital was not available. In the last 5 years, we've seen Sensex go from less than 20,000 to 60,000. All of a sudden, people have woken up and said, oh my God, You can make more money on the stock market than you can make in gold. So all this money has started emerging. Also, at the same time, foreign direct investment. When I was a youngster, $250 million was a good year for India. Now, I'm not going to tell you how old I am. But 250 million was good. That's $250 million. Last year, we had $62 billion of FDI. I mean, I may be incorrect in my numbers, but certainly in that range. So with the equity capital coming from India, with the equity capital coming from abroad, the environment for startups is so much better today. And I think it is the ideas combined with the digital highway, combined with the petrol to put into the trucks that are running on the digital highway. That's my opinion. Over to you, Ashish.
I think, absolutely, I agree with you. All those things are a reason why the startups are doing so well and the ecosystem that we've got for the startups in India. The other one, and particularly for fintechs, is there's been a pent-up demand. So if you look at the underbanked and the unbanked in this country, and in this country meaning India, it's around 75 to 80%. So either they're underbanked, so they require, whether it is loan, credit, financial products, and that was not available to them, or there were all these friction, whether it's payment and so on and so forth, right? So things were not that convenient, and so that, I think, is the other reason why there is such a big opportunity. That doesn't mean that there's not enough in pharma, for instance. You will see that there'll be a lot of now startups in that biotech in that area already happening, but maybe not as many unicorns. So that might happen in the next couple of years as well. So you will see that happening as well. But this was a really big opportunity for startups in India, fintechs.
And we forgot to thank the pandemic.
And yes, absolutely. Yeah. And so, because India is now the only growth market, and that's why you see, our Prime Minister Morrison really interested in a trade deal, and on the other side, the UK Prime Minister also visiting. I mean, all these things are happening at the same time. Everyone is trying to court India for that particular reason, because China is no longer as big or as important as what it was before. So it seems like all eyes are on India. And
India is becoming one of the tech centers for many, many companies. It's not just fintech. You take Medtronics, the largest research unit outside of North America for Medtronics is India. Goldman Sachs has opened a major office in Hyderabad. Microsoft is putting their data center in Hyderabad. So this is now a little bit of a pitch for Hyderabad. So those of you guys in the audience from Bangalore, you might start looking at real estate in Hyderabad. Just kidding.
Thank you, professors. I think we have about a minute. Maybe we could just take a quick question. Last question. When we talk EdTech, can you give some examples of value creation and appropriation that you've observed in the post-pandemic era?
You're talking about EdTech?
EdTech.
Well, I think EdTech, there's so many similarities, let's say, between EdTech and mobile phones, for example. In India, we didn't have landline phones. It took 20 years of waiting before you got a landline phone. So when mobile phones came in, there was pent-up demand, and they filled a big void. And that void wasn't there, for example, in North America. So the rate of penetration of, let's say, mobile phone technology in North America initially was much slower than the take-up rate in India. Now you look at education, same thing out here. There's a huge shortage of good educational opportunities in India, and EdTech is going to fill that void. Not only that, what we have in India is labor. A lot of EdTech is actually supported by labor. So when we had the pandemic in North America, lot of, families were doing homeschooling because schools were closed and it was online. Many of the tutors in North America were from India. So it's ironic that Indians are teaching the rest of the world how to read English. And so, that's been, kind of part of it. Now you take EdTech. Probably the oldest and the most visible name in EdTech used to be Coursera. Coursera is about $5.6 billion. It's worth $5.6 billion. Baidu is worth 3 times that. So EdTech is probably going to be one of those areas in which India will dominate, because I think we have the capability. And, it is also in line with the Indian mindset, with the value that we put on education. Perhaps I'm being too optimistic, but I'm seeing more EdTech come out of India than anywhere else right now.
Thank you, Professor. I think in the interest of time, we are 1 minute beyond time. And I probably will take this opportunity to thank you, Professor Ashish and Professor Rajendra Srivastava, for joining in, for sharing some great insights on how organizations are transforming today and preparing themselves for tomorrow. How do we sort of engage with this revolution and emerge as leaders, not just as survivors, in the coming near future? With this, it has been a great start to the session. Yes, Professor, sorry.
So just one thing to add, there have been some questions in the chat box. What we will do is we will, we will respond to those questions if we have not responded to them. So if the participants would please, look at our website in a week from now, we would have answered the questions. The unanswered questions will be answered, within a week. And we'll put that up on our website. Okay.
Sure. And Professor Srivastava, just wanted that we'll be having these sessions once every 6 weeks or so. Well,
I think initially I was thinking about 6 weeks because that was aligned to the cycle that we have. Our terms at ISB is every 6 weeks. But I think the rest of the world may be better off on a monthly schedule.
Okay.
So we're going to try to target on a monthly basis. And what we will do within the next couple of weeks is we'll come up with a schedule, the topic, and the faculty who will be holding the seminars at least for the next 3 months. So we'll come up with the next 3 months and we'll announce that within the next 2 weeks. And then we will keep updating it. So I'd like to thank the panelists, the participants. Please watch out for further announcements. And we really appreciate your jumping in and joining this inaugural webinar. And thanks again. And Prashant, back to you. You were closing before I interrupted.
Yes, no problem. Thank you very much. Actually, you've done the closing part. This is a great start to the knowledge series that Center for Business Innovation is putting forward. And we look forward to engaging with all the participants in the coming sessions. And Debashri, one of our team members, will post a quick feedback link just for us to ensure that we learn from our experiences. And she's already posted in the chat. It wouldn't take more than a minute. Would request all the participants to kindly share their feedback. And we look forward to engaging with everyone, wishing everyone a happy weekend and an amazing innovation journeys ahead.
Great. Thanks a lot, everyone.
Thanks, Ashish. Good night. I think it's coming close to midnight at your end or something like that.
10:30, so it's fine. It's fine.
Okay.
It's not too bad. All right. Great. Thanks a lot. This was wonderful. Really enjoyed it. And thanks a lot for inviting me as well.
Bye.
Okay.